Welcome back to Mastering MHA MBA. This is Chapter 13, Part 2 of 4. In Part 1, we isolated the flexible budget variance, the part of the gap caused by performance, not volume. Now we split it into its two drivers. Price, did our inputs cost more than planned? And efficiency, did we use more of them than planned? We will do this for direct materials and direct labor. There are only two reasons a direct cost can come in above or below the flexible budget. Either you paid a different price per unit of input than you planned, or you used a different quantity of input than you planned. The first is the price variance. The second is the efficiency variance. Together they fully explain the flexible budget variance for that cost, and they typically belong to different people. Purchasing owns price, the factory owns efficiency, so separating them is what makes the analysis fair. The price variance answers, did we pay more or less per unit of input than the standard? The formula is the difference between the actual price and the standard price, multiplied by the actual quantity of input you used. Holding quantity at actual, you change only the price, so you isolate the pure effect of paying a different rate. If steel cost more per ton than budgeted, that shows up here. This variance usually points to purchasing, market conditions, or supplier negotiations, things that drive the price you pay rather than how much you use. The efficiency variance answers, did we use more or fewer inputs than we should have for the output we made? The formula is the difference between the actual quantity used and the standard quantity allowed for actual output multiplied by the standard price. Notice the key phrase, standard quantity allowed for actual output. That is the flexible budget idea again, the amount you should have used given what you actually produced. Using the standard price here keeps price effects out, so this variance is purely about waste, spoilage, skill, and process. It belongs to operations. Let us make it concrete. Say the standard is 2 pounds of material per unit at $5 a pound, so $10 of material per unit. This period you actually paid $5.20 a pound and used 2.1 pounds per unit. The price variance comes from the 20-cent overpayment on every pound you bought, an unfavorable result driven by the market. The efficiency variance comes from using 0.1 of a pound too much on every unit, also unfavorable, driven by the floor. Same total overspend, two completely different causes, two completely different fixes. That is the entire point of splitting them. The beautiful thing is that direct labor works exactly the same way. The labor price variance, usually called the rate variance, compares the actual wage rate to the standard rate. Did we pay our people more or less per hour than planned? The labor efficiency variance compares the actual hours worked to the standard hours allowed for the output produced. Did the work take more or fewer hours than it should have? Same two drivers, price and efficiency, just applied to wages and hours instead of dollars and pounds. Learn it once, apply it everywhere. All of this rests on standard costing, the practice of setting predetermined standard prices and quantities for each input. Where do those standards come from? From engineering studies and time and motion analysis, from benchmarking against competitors, and from historical performance. This matters enormously because every variance is measured against the standard. If the standard is sloppy or out of date, the variance is meaningless. A loose standard hides waste, and an impossible standard generates fake alarms. Good variance analysis starts with honest current standards. The last few years gave us a live experiment in both kinds of variance. Material prices and wages both moved sharply, producing exactly the price and efficiency variances we just defined. Two updates from the field. First, the price variance. In 2022, raw material prices paid by manufacturers rose by roughly 37% year over year at the peak, with commodities like crude oil, metals, and grains the most volatile. That is an enormous unfavorable price variance, and crucially, most of it was market-driven, not the purchasing team's fault. This forced a hard lesson. When prices move that fast, the standard price built into your budget becomes stale within weeks, and companies had to update their standards far more often than the traditional once a year. Second, labor. Unit labor costs in US manufacturing rose around 6% in 2024, pushing actual wage rates above standard and creating unfavorable rate variances. At the same time, A tight labor market meant understaffing, turnover, and less experienced workers, which strained the efficiency variance too, as jobs took more hours than the standard allowed. So both labor variances came under pressure at once. The split we learned is exactly what let managers see how much of the labor overspend was higher wages versus lost efficiency and aim their response correctly. Recap. Any direct cost miss comes from two drivers: price, what you paid per unit of input, and efficiency, how much input you used for the output you made. You compute each for direct materials and direct labor, giving four variances in total, all measured against carefully set standards. Price typically belongs to purchasing and the market, efficiency to operations and the floor. Split them, and a vague cost overrun becomes a precise assignable problem. One caution before we move on: these variances are connected. Imagine purchasing buys a cheaper, lower grade material to score a favorable price variance. That low grade material breaks more often on the line, causing extra usage and an unfavorable efficiency variance. The price win caused the efficiency loss, so never read a single variance in isolation. A favorable number can be hiding an unfavorable one it created elsewhere. Always look for the trade-offs across variances, a theme we will return to in part 4. We have direct materials and direct labor fully untangled. But the trickiest cost of all is overhead, because it is indirect, pooled, and allocated rather than traced. The price and efficiency logic still applies, but with a twist, especially for fixed overhead. Part 3 takes on variable and fixed overhead variances. It is the most challenging part of the chapter, so I will keep it clear. See you there.